What if a flower cost more than a house, or did it? Today we're digging up the real roots of Tulip Mania. What boomed, why it popped, and what's myth. Hey, it's sketch figures, finance, sketch simply. If you like clear zero jargon stories with real receipts, tap like and subscribe. Stay to the end for a one-line test to dodge the next hype cycle. 16th century Dutch Republic, trade buzzing, money flowing, a taste for beautiful, rare things. Tulips had arrived from the Ottoman world decades earlier, and certain varieties showed dramatic stripes and flames. People called these broken tulips, not because they were emo, but because a plant virus disrupted pigment to create those striking patterns. Rare look, slower propagation, big status points. When supply adjusts slowly and demand chases status, prices can jump. Tulips reproduce by bulbs and offsets, so new supply trickles in over years, not weeks. Broken bulbs were rarer still and, crucially, weaker. The same virus that made them beautiful also reduced vigor. That combo, beauty plus fragility, made some names legendary. The most famous was Semper Augustus, often shown with candy cane streaks. Later research confirmed the look came from the tulip-breaking virus. These bulbs tended to weaken over generations, which helped keep supply scarce and stories spicy. You'll hear claims like, "one bulb cost a house." Some anecdotes exist, but modern scholars caution that many dramatic prices come from satire, partial lists, or thin records, and the wildest numbers aren't reliably documented. We'll separate legend from ledger shortly. Scarcity and status can lift prices, especially when biology keeps supply tight, but headline price claims deserve a source check. This wasn't a stock exchange with tickers. Most deals happened in taverns called colleges. People traded forward contracts, promises to buy bulbs later at a set price. Because bulbs were in the ground during winter, traders paid small wine money fees per deal. The Dutch even nicknamed it wind handle, wind trade, since lots of promises changed hands while the bulbs stayed put. A forward contract is like saying, "I'll take that bulb in spring at this price." That means winter prices reflected expectations, not immediate delivery. When goods are seasonal and forward traded, price spikes can look bubble-ish without mass insanity. The Economist highlighted this seasonality angle as part of the story. Economist Earl Thompson proposed that policy talk in early 1637, letting buyers cancel for a small fee, made forwards behave like options. Limited downside, big upside. If you can walk away cheaply, you'll agree to higher winter prices because your worst case is just the fee. That helps explain scary quotes without assuming everyone was swapping mansions for bulbs. The hypothesis is debated, but it fits the contract quirks. Surviving price data are patchy and often secondhand. We don't have a clean day-by-day market tape. That makes it risky to claim exact magnitudes with confidence. Still, the tavern-based, promise-heavy market design is well attested. Design matters. A thin seasonal market run on forwards in taverns behaves very differently from a cash market. Small legal changes can move mountains. Interest spreads beyond elites to merchants and artisans. As more people sign forwards, rare varieties fetch premiums, and even common bulbs drift up. The new and talkable status of tulips boosts marketability. They're easy to brag about. A helpful framework is the bubble triangle. Marketability plus money/credit plus speculation. Add a spark and you've got a bubble. Tulips checked several boxes. Saleable narrative, a way to lever exposure via tiny upfront costs, forwards, and a buzz-heavy culture. You'll see dramatic lists. Bulbs priced at many times a skilled worker's annual wage. Some are real quotes, others trace back to pamphlets or satire. Historian Anne Goldgar went archive deep and concluded the frenzy touched a fairly narrow slice of society. Lots of participants carried on with business after 1637. So yes, prices ran, but probably not a nation-engulfing delirium. Economist Peter Garber argued that pricey novelty flowers can be rational at first because propagation is slow and fashion waves matter, so initial highs aren't automatically madness. That doesn't deny speculation. It reframes part of the run-up as supply/demand for new varieties. Thin markets plus contract leverage and a great story can turbocharge prices, even if the mania stays niche rather than national. If this is making bubbles make sense, tap like and subscribe so more people find sketch figures. Then the sizzle stops. In the first week of February 1637, auctions sputter, famously in Harlem, and buyers hesitate. Deals that look tradable suddenly look heavy. Exact minute-by-minute details are fuzzy, but that week is the turn. Liquidity, confidence that you can resell, evaporates. Because these were forwards, not paid-up purchases, the pain shows up as broken contracts more than immediate bank failures. Authorities debated whether contracts could be voided for a fee, which circles back to why winter quotes may have looked option-like. As disputes piled up, courts and councils hashed over settlements. The broad economy, however, kept humming. The tulip trade wasn't tightly plugged into the banking system, so there was no systemic credit shock. That's one reason the crash didn't morph into a nationwide depression. What sparked the break? Plague anxieties, buyer fatigue, early sprouting signaling supply, or simple, no more greater fools? One study links the timing to biological signals. Prices rose from November, planting, and cracked when early sprouting revealed more about bulb conditions and likely yields, first visible in Harlem's geography and temperatures. Neat idea. It complements the contract story. Crashes are worst when hype meets leverage and bank plumbing. Tulips had hype and leverage-ish contracts but limited banking links, so big splash, smaller crater. Much of what we know comes from Charles Mackay's 1841 bestseller, Extraordinary Popular Delusions, and the madness of crowds. Great storytelling, huge influence, and not always tight on sources. Modern researchers who combed archival records give a more nuanced picture. Legends grow when data are thin, spotty ledgers, satirical pamphlets. Narratives travel. It's easier to retell a bulb equaled a house than a legal clause. Moral clarity sells. Greed gets punished. Economist Peter Garber highlighted the novelty flower angle and pattern of high initial prices that settle as supply expands. The economist added that seasonality can explain part of the spike without invoking mass insanity. Historian Anne Goldgar found that the tulip trade involved a small web of people, and post-crash, many were still buying houses, art, and starting businesses, contradicting the idea of a country leveled by tulips. Meanwhile, policy talk about cancel-for-fee settlements underpins Earl Thompson's option-like interpretation. Both strands push back on simple madness takes. Was it the first big bubble? It's often called that, but first is slippery. Earlier crazes and later ones, South Sea, Mississippi, are better documented. What's solid? Tulips gave us a template story, narrative plus contracts plus liquidity, that reappears across centuries. Tulip Mania is a cautionary tale, but the caution is about market design and stories, not just people went nuts. Bubbles return wherever we have new tech, hard-to-value assets, or thin markets. Charts don't protect you. Habits do. Morgan Housel's The Psychology of Money makes a simple point. Results often depend more on behavior than IQ, your patience, envy, and FOMO management. Robert Shiller calls it narrative economics. Contagious stories change what people are willing to pay. Once the story turns, prices can too. Naming the forces helps you see them. If you want a quick gut check, use the bubble triangle. Marketability. Is it easy to brag about and trade? Money/credit. Is cheap money or leverage juicing demand? Speculation. Is the main reason to buy because it'll be worth more soon? Tick all three, you're in a heat zone. The who buys after me test. Before buying any buzzy thing, write 3 specific categories of next buyers and why they'll pay you more. Utility, status, cash flows, regulation change. For a rare collectible, museum, curation, brand, marketing, collector, completing a set. For a token/stock/flower, user clear utility, institution policy shift, business cash flow value. If your list is someone even more excited, that's win trade energy. In 1637, contracts were shuffling among speculators. Once they doubted the next buyer, everything froze. Sometimes hype funds real innovation. Sometimes thin, legalistic markets cushion crashes. As with tulips, your job isn't to predict tops. It's to size positions so you survive if the story flips. That's behavior, not brilliance. Stories spark. Plumbing amplifies. Habits protect. Run the triangle and the who buys after me test before you jump. Tulip Mania shows how stories, seasonal contracts, and thin liquidity can look like mass madness without wrecking an economy. Quick rewind. A rare virus-striped flower meets tavern forwards and status, rise. Winter quotes soar as expectations and seasonality bite, peak. Early February doubts and legal wrangling pop the market with limited banking fallout, outcome. Today this means check the plumbing, who settles what, when, and how, not just the chart. Run 2 filters, bubble triangle plus who buys after me, before you size up. Mind your behavior. Label FOMO, patience beats hot takes. If this helped demyth Tulip Mania, subscribe and ring the bell. And if you haven't already, check out our last video on what inflation is and why your money is losing value. This video is for education only and isn't financial advice.